Hey YouTubers, it's Thursday 24th of November 2011. We have silver coming in at £20.46 pence or pennies, 31 US bucks and 73 cents. Gold coming in at £1,092.17 pence or pennies, or 1,694 US dollars and 7 cents. I'm going to concentrate on the UK on this video because it's been keeping a very, very low profile while Germany and France and Spain and Italy all kick up a fuss, hasn't it? So here we go. All these links down below. Young jobless NEETs reach record level. Most of these links came out today anyway, so it's all up to date. The number of young people not in education, training or work has risen to a record level in England. Official figures, blah 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 blah. 1,163,000 people are not in education, employment or training. That's what NEET stands for, not in education, employment or training. So I don't know how those people are ever going to get out of that situation, but down here they have, where was it? Come on, there they are. We are committed to raising the participation age so that all 16 and 17-year-olds are in education or training by 2015, and we are reforming vocational education to ensure that there are high-quality opportunities for all young people to participate, she said. So nothing's been done. They're committed to raising the participation age. Don't know how they're going to do that. War of words over claimed strikes could cost jobs. This is where we have a massive strike in the UK planned for the 30th of November. You can just see down there. This guy here, I'm just going to answer his statements as he says them just quickly.
Lost output to the United Kingdom. That's as a government, we're putting in place contingency plans.
So they're putting in place plans. They don't have any. This is about the strike.
Looking at ways in which we can find additional staff for our...
They're looking at ways, so they haven't done anything about
borders,
that.
For example, to ensure that as much as possible we can maintain services. But of course, being realistic about it, if all the members of all the unions who have balloted go on strike, that's going to have a significant impact on our economy. We estimate, in the worst case scenario, potentially £500 million of lost output to the...
Right, so £500 million. Let's keep £500 million in mind because we'll get to that towards the end of this video. But yeah, this is a massive strike. It's going to occur in the UK next week, and there's not a lot they can do about it. But you know, they're saying it's unfair for you to strike, and the unions are saying, well, you've just messed with all of our pensions. What do you want us to do? Just sit back and take it? No. Next, latest UK GDP figure raised fears on looming recession. Now, this is brilliant. This is. UK GDP figures. Third quarter economic growth of 0.5% was driven by manufacturers rebuilding stocks, a pattern unlikely to be repeated. Now, I did a video on this a little while ago, but there is a beauty in here. The rebuilding of these stocks more than accounted for the 0.5% growth in the third quarter, according to the ONS, though it was offset by a drag from the net trade and business investment. Government spending also contributed positively to growth. Now, excuse me, ladies and gentlemen, I thought the government was having spending cuts. Next, where are we? UK housing market could fall into a US-style vicious cycle. Could. However, he says that without ever increasing mortgage finance, housing equity cannot support rising house prices indefinitely. That's the problem with the whole system. The whole system is based on growth. Continued growth. It must continue growing, like I said in my last video, or the beast dies. He says we expect a weak economy and the sheer extent to which housing remains overvalued to force prices down again for the next few years. The danger is that as housing equity is destroyed, households will find it harder to remortgage, triggering repossessions and further falls in housing equity. In other words, the UK may be unable to afford a self-sustaining fall in house prices. The good news is that the amplifying effect of housing equity on house prices movements won't drag prices lower indefinitely. So all those people that have just, you know, bought a house, you're basically in negative equity for the next couple of years. Genius. Next, UK CPI inflation rate rises to 5.2 in September. Inflation, the 5.2% rate is the highest CPI measured since September 2008, and it has never been higher since the CPI measure was introduced in 1997. 1997, eh? It's just over, what, 23 years? So you've only got 23 years of this. 23 years. Prior to that, there was nothing happened in the 1930s, no? Right, okay. The retail price index, RPI, which includes mortgage interest rates payments, rose to 5.6% from 5.2%. Now, like I said, the UK has been keeping its head down. Let's have a look at this UK inflation rate. Now, currently, this is from January 2006 to November 2011, where we are today, and we can see that, you know, January 2008, we started to have a little looky above the 5.2%. Bang, 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 and here we are now back up there. Now, I'm not saying that. Should we take an average here? Or, you know, should we say we have support at 3% per se? Now, this is looking at you and your savings. This is the inflation. Okay, let's say you got £1,000 in the bank in 2008. In 2011, it is equivalent to what? Now, let's just change this to 3%. So we're not at the current rate. We've gone back to 3%. So with this calculated now, 1,000 in 2008 is the equivalent to £1,092 in 2011. In other words, 1,000 today can buy the same as £912.67p could in 2008. So you're down about 80 quid on your savings. But we know that the inflation rate is not currently 3%, is it? It's 5.2%. So let's just calculate that. And in other words, 1,000 today can buy you the same as 851. So if you just had £1,000 in the bank, you have lost, round it up, 150 quid in purchasing power. Now, just remember that guy said, what was it, $500,000? Was it million, billion? Who cares? There's the bomb. There it is, 900 billion. And ticking away quite happily. Now, the UK has been keeping its head right out of this. Now, Goldman's 5 months ago, when Italian yields were the same. Oh dear, I read that wrong. 5 months ago, when Italian yields were still tame in the 3% ballpark and not 7% where they are today, we suggested that based on trading patterns and overall volumes in Goldman's dark pool, Italy may be about to experience a Greek episode. Days later, we were proven right as the Italian yields and spreads started their relentless move wider, with only those that had access to Sigma X being able to get an advanced whiff of what was about to happen. Well, today we are happy to report that the German diversion may have worked. The truth is, nobody appears to care about Germany. Instead, what everyone does seem to care about is the nation with the greatest combined debt, government, corporate and household to GDP in the world, the UK. And there, ladies and gentlemen, is where we are. Now, if you look at the business and bank debt compared to everybody else, this is why I think sterling is going to get smacked before the euro. And just on a final note, I was just watching a little item on eBay. 24th of November 2011, 1 ounce pure gold Krugerrand at 1974. Now, I know this guy's got no feedback, etc., etc., but if somebody's just bought that for £440, that is the deal of the day. Link is down below, guys. Watch yourself.